Sometimes I get clients who ask me, "Hey, Miles, should I buy down my rate and pay discount points?" It's a worthwhile thing to explore. Today, I'm going to show you and make sure first you know what discount points are. Number two, I want to make sure you know how to evaluate them and make a decision if it makes sense or not. And then hopefully that'll help you. And it can potentially save you thousands and thousands of dollars in interest in the right situation. So my name's Miles. I own Superior Lending. First of all, discount points is a way of permanently buying down your interest rate. Sometimes we call it a permanent buy down. Discount points, just a rate buy down. But what you're doing is there is a cost to step down from where the start rate is. And the more you step down, the more you're going to pay to lower that rate. You're prepaying the interest on there. And when you hear somebody say, I'm paying 1 point for my rate buy down, 1 point generally is 1% of the loan amount. So let's look at this. So by the way, there is not an exact formula on this because the rates and how much the buy downs are greatly affected by what your credit score is, the loan type, and how much down payment you have. By the way, this also works on FHA, VA, USDA, and conventional loans. You can do discount points. So we're going to take a scenario and walk through it. I'm going to totally be a mortgage geek and show you some of our rates and some of the rate charts that we have. We're going to look at a client who wants to go from a 6.5 down to a 5.75 on their interest rate. So first of all, let me make this bigger. Our scenarios we're going to go with is a $550,000 purchase, 80% loan to value, or meaning they're putting 20% down. So our loan amount's going to be $440,000. These guys have excellent credit. Okay. So what you're looking at right here is you're going to see down the left-hand side all the different rates that are available. Many times lenders will you call up and you say, what's my rate or what's available? You give them one rate. Okay. The truth is all of these rates listed here are available. It's just, do you want to pay to get that rate, pay the discount points, or do you want to get a credit? So we start with what we call as a par rate, and that's right here in the middle where it's kind of in between there being a charge or a credit. If you go lower in rate, which is moving higher on this table, you're going to be paying more and more or discount points to get that rate. If you go the opposite direction, you're going to be getting a credit from the lender that can help you. You can use those to cover closing costs. You cannot use any of that credit to cover down payment, by the way. So our client in our scenario wants to move from the 6.5 to the 5.75. And you can see where the purple arrows are, that in order to get to 5.75, it's going to cost 2% or 2 points, which based on our loan amount is $8,800. And you're going, wow, that is a lot of money to buy down. Well, how much does that actually save the client? $213 a month for the life of the loan is what it saves the client. So let's evaluate and see if it's worth it. So what we do, I have this cool calculator. We plug it in and we measure the break even. So it's going to cost $8,800 a month. We divide that by the monthly savings of $213. That means our break even's at 41 months or 3.41 years. Okay. Why is that important? Because we then ask ourselves the question, is it worth it to do it? And every scenario is different. It's a case-by-case situation, but it's worth it if you believe that you will not be refinancing or will not be selling the home within 3.41 years. Yeah, it's probably worth it. If you believe that rates are going to get worse in the future, and then it's going to be very much worth it to do it. The other reason is if you are a borrower that you want to qualify for more home, or your debt ratios, what you're qualifying for is a little bit higher than you want, and you need to improve those debt ratios, doing this, the discount points or a permanent buy down is a really good thing to do. Okay. Reasons not to do discount points is that if you are going to be doing a refinance in the near future because you believe rates are coming down, you shouldn't do it, because if you pay the discount points and our break even's 3.41 years out and you refinance 6 months from now, all that money that you just spend on those discount points is poof, gone. It was kind of a waste. You would have been better off doing an alternative. And let me give you some alternatives. And I'll link to a video that walks you through what a temporary buy down is, how it works, and the situations where a temporary buy down is going to be better than paying discount points. Temporary buy downs typically make sense where the seller or the builder, I put building, that should have said builder, is paying for a bunch of seller concessions or seller paid closing costs. The other alternative that you can do is just to say, you know what, that money, Mr. Seller, or that you were going to spend on buying down your rate, you can take and just reduce your purchase price and or reduce your loan amount. That's always an option. So this is where a loan officer who understands the objective, your scenario, and has these cool calculators to be able to help you out can help you make a decision. Okay. My team's always here to help you evaluate this. If you ever want to bounce the idea off of us or ask, should I buy my rate down? Should I pay discount points? Or is there a better alternative? Give us a call. Here's our contact info. Thanks for watching this video.